Anytime you're looking at multiple investment opportunities, or you're trying to figure out if the one investment opportunity you're looking at is a good fit for you, one of the best metrics you can use is something called IRR. IRR stands for internal rate of return, and it's actually a pretty simple concept, but it can get confusing because it's not something we hear in other financial services usually. Put simply, what an IRR is a summary of all the cash flows from the initial amount you invest, and it takes up and adds up all the cash flows that you get throughout the life of the investment, and it finds out what return you'd have to get elsewhere to equal those same cash flows. Now, it's important to understand that IRR takes time into account. This is really important because getting $100 today is much better than getting $100 in a year from now, because every year inflation goes up and the buying power of a dollar is worth less. Now, that's one of the best things about IRR, is that it does take time into account. However, it's important to understand that that can skew results of different opportunities if they have different timelines. And I'll show more of that here in a minute in some of these calculations. Now, what we have on this sheet here is several different scenarios that I drew up, and I want to illustrate something interesting about how IRR works in the real world. To calculate IRR, it's really pretty simple if you have something like Excel or Google Sheets pulled up. All you have to do is look at the investments and make sure that your initial investment, which is a cash investment, is a negative number, and then all of your cash flows are positive number. Otherwise, your numbers won't work. But what we come down here is we put in the simple formula, IRR, and then parentheses, we have all of the cash flows. Now, it's important to understand that if you go much past it, you kind of want to stop at when the investment ends. Otherwise, it can skew the results sometimes. But what we're looking at here is five different scenarios. And interestingly enough, they all have the same IRR. What this means is that from a math perspective, you do just fine with all these investments. You actually get the exact same return on your investment. But it's pretty obvious right off the bat that these are totally different, right? And so just going off IRR, I hope this illustrates that you do not want to just use that. You have to figure out what your goals are. So let's look at example A. Now, this would be something maybe like a long-term development, right? It's something that's going to take 2 years to get in title, 3 years to build, and when it sells, you double your money. Well, that right here gives you an internal rate of return of 15%. You didn't get any money for the first 4 years, but once the fifth year came around, you doubled everything and you got 15%. And as a quick side note, if you ever want to figure out how long it's going to take to double your money at a certain IRR, you can divide 72 by the IRR and you get the number. Don't ask me why. I don't know. Somebody got like a huge math prize for figuring that out, but that's just the way it works. Now, here in scenario B, we're going to put in $100,000 and we're going to get $30,000 every year, and then it just stops. So this is something maybe like an oil and gas investment where there's no big sale maybe, but you get really, really high cash flows. And maybe this is a better fit for what you're trying to do. Now, when we add it up, we can already see that this is not equal to 200,000. This actually equals a good bit less. So how does it have the same IRR? Well, you're getting money sooner, right? And the idea behind this theory is that the sooner you get the money, the better, because it's worth more. So you can reinvest it or whatever you want to do with it. Now, in scenario C, we're going to invest $100,000. And then 1 year later, we get $115,000. So a real world application of something like this would be, you're a private lender, somebody that you're going to charge 12% for them to borrow money from you to go flip a home. You get 2% on the front end, maybe 1% on the back end. So you get 15%. And you get the initial amount back. But again, it still has the exact same IRR as the other ones. Now in scenario D, we're going to look at something that's probably more like a typical maybe multifamily investment, where you're going to put in $100,000, you're going to get some cash flows. They're going to be okay. And then at the end of it, you're going to get your money back plus profit from the property being sold. And when you add it all up, your IRR is again 15%. Now, in this last scenario, this one's really interesting because this is kind of what most people want, I feel like, in their heart. They just want to invest once and get paid forever. But what's interesting about that has the exact same IRR, right? We're going to put on 100,000, and this one goes all the way down here. I think this was year 30 or something like that. And I had to put the calculation over here, but again, the IRR is still 15%. So that's a really, really interesting fact here. Like, IRR is not the only thing that you should use to figure out if a deal makes sense for you. What do I mean by that? Let's say that you are 60 years old, you're getting ready to retire, you have some money and you want to get some cash flow to live off of. Scenario A has the same IRR, but that might not make a whole lot of sense for you. Scenario C, also, you only invest once. So you have to keep doing this and you have to keep finding opportunities. And that doesn't sound like retirement. That sounds like a side job, which maybe you want to do, and that's fine. But again, that's probably not the right strategy for you, even though the IRR is exactly the same. Now, scenario B might make more sense for you, right? You put up the money today and you get to live off those cash flows, but then they stop. Whereas scenario E, or scenario D, you put up the money today, you get the cash flows, and for this one, it keeps going, and then you get the money back. So you'd have to reinvest after 5 years. In scenario E, you just invest once, and then you're good, right? So IRR should be taken with a grain of salt. You can't look at two deals and say one has an IRR of 20% and one has an IRR of 10% and say one is better than the other, right? There's more to it than that. Now, here we go. Here's another example showing how extreme this looks and how you can actually have a higher IRR on an investment. Sorry, I'm sounding like a walrus, keep saying IRR. But you have a higher IRR, even though you're going to make substantially less money, but the money is sooner. So in this scenario, we're going to invest 100K. We wait 5 years, and just like the scenario over here, we get 200 grand. So we averaged an annual return of 15%. This might be a land deal. You're just going to buy land. It doesn't produce anything, and then you sell it. Scenario B, we're just going to put up 100 grand and get 18,000, but we get it at 12 months versus 60 months, and our IRR is higher. Again, that might be what you want. This might be what you want. It really depends, right? The practical application for this is that if you can just continuously put the money back in, yeah, you're going to be better off with the higher IRR, but can you, right? So a lot of this comes up in home flipping, right? People can get a really quick return on their investment in 5 months or whatever, and they say, oh, look at my IRR, it's 50 plus. But they only do one a year, and then it takes them like another 12 months to find one. So it's like, is that really your true IRR? I don't know, right? Now, in this last one, we're going to kind of show how the dollar amount can continuously go up, but if it goes out further into the future, your IRR actually plummets. So this one's pretty simple, right? We put in 100 and a year later we get 150. That's a fantastic investment. If we could do that every year, we'd basically a Wall Street genius or a real estate genius, or you're Nancy Pelosi, right? One of the two. But in this case, what's going to probably limit you in the real world is the practical application of continuously finding these. But let's look at the math here. We get a 50% IRR with 50,000 profit. We get a 40% IRR with a $100,000 profit, and we get a 36% IRR with a $250,000 profit. Now, why do you need to know this? Because you will look at a lot of investment opportunities, whether you're an active investor or a passive investor, like an LP looking at syndications. And you have to understand that if the deal you're looking at, one has a super high IRR, but it's a 3-year hold, and one has a modest IRR, but it's a 5-year hold, which one should you prefer? Now, that's really up to you. But what you need to understand is that that IRR is so much higher because it's shorter. Now, that might be realistic. Typically, what you see is people either underwrite to 5 years or 10 years with something like multifamily or mobile home park investments. Yeah, you could probably sell it at the end of 2 years and, really juice your IRR. But then it comes back to the question of like, do you have another opportunity right away to put that into? Or are you just making the numbers look better by just shortening the timeline? So be on the lookout for that. If it's less than 4 years and it's an asset that probably has a realistic 5-year lifespan, something like an apartment or a mobile home park investment, something like that, then you need to be aware that that's something you got to pay attention to. Now, let's look at a very, very real world application use for this. This is something that I get questioned on all the time from investors because they look at my deals and they look at IRR and they say, well, the IRR I see on other deals is much better. Why? What gives? They look at the numbers of the park and what we're buying it for and what we might get for it, and they think it's going to have this really high IRR. But usually I'm substantially lower than other people, which I don't think is a bad thing, and I'll explain here in a second. The biggest thing to understand between these two scenarios we see here, in scenario A, which is we're going to sell at the end of year 5, we're going to get our initial investment back, plus all of our equity that we built. In scenario B, we're going to get to year 5. We're going to refinance, get our initial investment back, and then we're going to continue to own the property and cash flow. Now, right here, I just kind of explained this scenario, right? We're going to put $100,000 down. We're going to buy a $400,000 property. We're going to get a loan for $300,000. And what did I say was going to go up? It's going to go up 5% a year, right? So this is a pretty modest investment. The real estate's going to appreciate 5% a year, which could be market appreciation, forced appreciation. Doesn't matter for the example here. But it's going to go up. It's going to go up. And then at year 5 is worth 510, and we're going to sell it. So for simplicity, I assume this was an interest-only loan. So we have 510. We've got to pay off the 300. We're left with basically 210. Now, what you see in these two scenarios here are the exact same cash flows. I did not change the cash flows, including up to year 5. In this scenario, we have the $18,000 cash flow, which is our year 5 cash flow. And in this scenario, in this scenario here, we also have an $18,000 cash flow. The difference is, in this one, we have the year's 5 cash flow plus the profit from a sale. And in this one, we have the year 5 cash flow plus our refinance proceeds. Now, obviously, we're walking away with way more money earlier. And so the IRR in this investment opportunity is 25, which is fantastic. And this one is 17, which is good, but it's nothing to write home about. You can throw a rock at a syndicator on LinkedIn and find somebody who can get you a 17% IRR. If you don't believe me, just go do it. You can totally do it. So the question I get a lot is, why don't we sell it? Right now, there's a real world application for this, and that I think that mobile home parks are a dying asset, and the supply is actually being reduced over time because nobody's developing them. And for me, I think it's one of the best assets to own in terms of stability and recession resistance. So I'm fine with the lower IRR. But the mathematic answer I have to this is that usually this IRR is a lot higher than it really turns out to be. And the reason is taxes. Most of the time when you look at an investment opportunity, it's not going to be the responsibility of the sponsor or the broker, whoever shows you this deal, to calculate your taxes for you. They're just going to show you how the deal performs. Now, what you do with that and what taxes you owe is your problem, right? And so that sounds bad, but that's just kind of the way it works. It's not my responsibility to make a estimate on what everybody's taxes are going to be. But let's just take some real simple math. Now, we're going to assume we're in like a 25% tax bracket, which is kind of like the capital gains, depreciation, recapture, and most people might have at least some money in the 25% tax bracket if they're investing, right? So let's say we look at this sale price, which right now we didn't account for taxes, but let's do that. Let's say we basically reduce the sale proceeds by 25%. Now we have, that looks way better. Not 70 times more, 0.7 times more. Okay, so that was a big hit on our IRR. Just the fact that most of that equity is going to get taxed at 25%, very quickly it brought them both down to a more similar playing field. Now, this is where the real world side of it comes in. Do I want to get a 20% IRR and have to put all of my net worth into a brand new property that I'm going to do due diligence on, but at the end of the day, I don't know it as well as I know this property that I've been operating for the last 5 years, right? Or do I want to pull out my initial investment, keep the property, continue to cash flow, keep a property that I know and understand, and then put the same amount I put in that first investment into another investment, right? That's kind of what I typically like to do. But the other aspect of this is that right now we have something called bonus depreciation. So I have a whole separate video series on bonus depreciation, so I'm not going to get into the weeds of it now. But for simplicity's sake, let's say when we buy this opportunity, we can write off $200,000 worth of the purchase price. Now, if you're listening to that and saying that's ridiculous, that's actually lower than what we normally do. And typically we're around 60 to 70%, not 50%. But for now, I'm going to keep it simple. And if we say, okay, we are going to be able to write off $200,000 worth of losses. Now, if you're a real estate professional in the IRS's definition of that, you can offset your income with that, right? Otherwise, you can only offset your passive income. But let's say we do that. In both scenarios, we're going to get, well, actually not both scenarios. In this scenario where we refinance, we're going to take a $200,000 depreciation loss, which means if we offset $200,000 worth of income, and we're in the 25% tax bracket, that's an actual savings of $50,000 cash, like cash you actually keep in the first year. So let's go to this first year and let's add that in. Okay, now we've got a really high IRR. Now, if you're saying, well, that's not fair, you didn't account for that in scenario 1. That is true. I did not. However, if you take such a massive loss on your investment and you sell it in a short time period, like 5 years, you've got to pay it back. And you're not paying it back at the same rate. The IRS is making you pay it back at a higher rate, which I think now is like 25%, which means you're robbing Peter to pay Paul, right? Now, this may work for you, right? You may make the calculation that, hey, if I save $50,000 in year 1, I can get an IRR of whatever. And then when I have to pay the depreciation capture back, I'm actually better to take the loss now, keep the money, invest it in something, and then pay it back later when I sell. That is a very legitimate argument that lots of people would make. I would say from personal experience, it's pretty hard to do that in 5 years. If it's a 10-year-old, no problem, right? You can definitely put that saved money in some sort of investment with a 10-year horizon. Typically, you're going to come out ahead to do that. But in this scenario, what are we doing, right? Why are we not worried about the depreciation? Well, because we plan to hold the property indefinitely. So we basically told the IRS, we bought this property and went down in value, and now we're good. We're not going to pay it back because we're not going to sell it. Now, what you might be saying, it's like, well, didn't you get this property appraised? Didn't it go up in value, and didn't you get a loan? I did. But is a loan taxable? No. Now, that part is probably going to drive you nuts, and it's going to seem like I'm just bold-faced lying to you if you haven't been in the real estate game for too long. And you're going to seem like, well, that doesn't seem fair. Where do you pay your taxes? This is where I hate to break it to you, but this is why real estate is such a popular investment vehicle with the wealthy, because a lot of times you don't owe a whole lot of taxes. So yes, you can literally put in the money, you get your cash flow, you saved money right off the bat. When the property went up, you pulled your money out through a refinance, which is basically a new loan on the property now that it's appreciated in value, but you don't have to pay back your depreciation yet because it's not a taxable event, right? And so this is what I have found, and I have run the scenario a bunch of different times to double check it, but mathematically, I think this is why I prefer to refinance versus sell. Even though it feels like you're getting a lot less cash, it can actually be a lot better. And the reality is, over time, you have property that you own. And in the real world, you just get better and better at those properties. You get leaner and leaner because you know the right vendors. You know which tenants are going to have issues. You can anticipate things. You're not constantly every 5 years cycling all of your net worth into a brand new property, a brand new project that you don't know, right? You buy the property. Once that's done, you have the refinance. But other than that, there's not a whole lot of work to do to find a new opportunity. So I hope this video was helpful, and I hope you got a lot out of understanding how IRR works and also how to use it to analyze opportunities. Again, none of the financial metrics like cash on cash return, equity multiples, IRR, none of that by itself can tell you if one investment opportunity is better than another, right? It just, you can't do it. It's too complex. What you have to do is understand how these work and figure out which one of these is the best fit for you, right? If you don't need the cash today and you'd much rather go for a doubling your money quicker in a property with no cash flow, that's what you should go for. If you want cash flow today and you don't care about a big sale down the line, that's what you should go for. They may have the same IRR, or the one strategy might have a higher one, but you have to understand your strategy and figure out which opportunity is going to be the best for your strategy. If you got anything out of this video, please subscribe to my YouTube channel. I'm always trying to work on putting out content like this to educate people on real estate investing and how it works. And if you haven't yet, you can go to our website, aspenridge.capital, to get our free ebook on why mobile home park investing makes sense in 2025. Or if you're interested in looking at one of these deals in the real world, definitely take the time, schedule a call with me. I'd love to talk to you about your goals and see if Aspen Ridge can work with you on those.